Good morning, everyone. My name is Massimo Fuggetta. Very happy to be here. This was a last-minute thing. I'm replacing somebody else. And it's my first time in Madrid. Very briefly on my fund, I run the Made in Italy Fund, which is a fund which is invested entirely in Italian small caps, which we define as companies with a market cap of less than $1 billion. Why do I have a Made in Italy fund? Few reasons. The Italian stock market is small. Its total market cap is 550 billion, which, as you know, is less than Apple. There are about 350 quoted companies, which are less than half of what is quoted in France or in Germany. And not only that, but the market is very concentrated in 4 sectors. You have lots of financial companies, lots of utilities, E&I in oil, and a few consumers, which you know, FCA, Ferrari, Luxottica. So the MIB 40 index that contains the largest 40 companies is basically equal to the all-share index. And most Italian equities funds are invested around the MIB 40 index, with the consequence that small caps, which are 80% of the quoted names, are only about 8% or less than 80% of the total market cap. They are underfollowed, underinvested, and below the radar screen of most domestic and international foreign investors. And that's where I think the opportunity is. There's this graph which shows in very graphic terms what I mean. Look at the green lines. Does this work? Yeah. Look at the green. This is the the green lines. This is the Italian MIB index since 2007. It's one of the few markets that still has to recoup the 2007 level. The lighter green is the Europe index, which is way above. The small caps sector the small caps have done even worse than the mids. This is the red, the small cap index. Compare it to the light red, which is the small cap Euro stocks, which have done well and even better than the large caps. But the point is that small caps is not an asset class. Small caps is a big cauldron where you have all sorts of things. And if you're able to extract from that big cauldron the very best companies, you can do a lot better. And there's no more evident proof of that than looking at what a segment called the star segment in the Italian stock market has done over the years. These are small caps, but the best run small caps, which have to observe stricter governance regulations. They're more transparent. They have better boards. They have better management. And look at what they've done over time. They have done a lot better than everybody else. So in one line, the purpose of my fund is to invest in star companies, hopefully the star companies of tomorrow, as opposed to the ones that have already expressed their value in the last few years. And the fund started in 2016. And touch wood, so far so good. These are the numbers to the end of last year. Our fund was up 23%. more than double the universe average, the Italian equity funds average. I also compare it to two ETFs. One is the iShare ETF, which reproduces the MIB 40. But closer to what I do, the Lixer ETF invests in small and mid caps in an ETF way. And again, we're doing much better than that. If you look at standard deviation and beta, it looks even better. The standard deviation is a lot lower than the rest, as well as beta versus the MIB is only 0.4, which is not what you would expect from a small cap fund. Some of you might have actually seen a recent presentation that I gave at LBS a month ago that shows that standard deviations and beta are not very good measures of what value investors mean with risk, but numbers look good, so I put them on the presentation. So enough about the fund. The key concept of my fund is that Italy has always been messy when you look at it top down. Weird politics, complicated stuff, the microenvironment has always been challenging. And that's what people worry about Italy, especially in the last year or so with the new government, unproven people, messy. So it has been quite challenging for us last year to propose the fund, because people understand that the best way to look at Italian companies is from a bottom-up basis, but they prefer to wait. And while they wait, in the first quarter of this year, the Italian stock market, the MIB 40, has gone up more than most European markets, with the exception of Greece. And on a worldwide basis, only Chinese stocks did better than Italian stocks. This is to prove that all this macro theorizing and speculation is pretty worthless. So the company I want to talk to you about is called Landi Renzo, and interestingly, it's sort of in the same space as Christian's company. What they do is they produce and distribute alternative fuel systems for the automotive industry. And they also have another business, which is natural gas compression and distribution. This is a company I've been following for many years. And I don't want you to look at these numbers. They will be for your reference. But just to say there has been a convoluted history. Something that will never appear if you are a quant or a algo investors and you look at so-called objective data. You have to actually know the story of the company. You have to know what happened, and it's not something that will appear in any number on a screen. The product of this convoluted history is this horrible chart. I, for obvious reasons, stayed well away from Landi Renzo for a long time. And the fund started in 2016. It was actually below my own radar screen, let alone other people's radar screen. Until at the end of 2016, a new CEO emerged. I didn't know about it. I missed it. So I only got to notice again what the situation was later in 2017, and it's when I met him, spent time with them, and finally got to invest in the company. What do? Gas mobility systems. A car, a passenger car, can be transformed with the same engine into a car that runs on natural gas. This is something that's existed for a long time. Landirenzo produces all the little components, regulators, tanks, valves, switches, injector rails that transform a passenger car and, as we will see in a moment, very importantly, heavy-duty trucks into things that can run on natural gas. Last year, the revenues was 188 millions, plus 12% versus 2017. EBITDA of 25.3 million versus 10.7 previous year. EBIT 11.3, and this is key, versus minus 11.9 in 2017. So it's a turnaround. 6% EBIT margin at the moment, which in this industry, as you probably know, is quite high. Their net income in 2018 was 4.5 million. So if you divide 188 with 4.5, you don't get a very attractive PE. But hang on. So as we all know, the automotive industry is facing deep transformation, disruption. The key word here is, as we all know, decarbonization. There are tighter emission limits, which increase the total cost of ownership of a vehicle. And the major trend here is replacement of diesel. Diesel engines are going to disappear because they are expensive and polluting, and they will be out. But replacing them needs a cost-efficient alternative. So what is the space? Obviously, what everybody talks about, as Christian said, is battery electric vehicles. But it's much more complex than that. There are other alternatives. We know hybrids. Hybrids have basically two engines, a mechanical engine and an electric engine, and they've been doing very well in the last years. What we don't know, what is not well known, is alternative fuels, which are, unlike hybrids and unlike battery electric vehicles, ready to use. They're there. And require low R&D expenditure for the incumbents. And finally, there's something that nobody talks about. We have hydrogen and fuel cell electric vehicles, which will be there. They're not here at the moment, but will be there by 2030. Why is it complicated? Because the evolution away from petrol and diesel will differ substantially on a country-by-country basis. When we think of electric vehicles, we think of Europe and the US, but think of India, think of Russia, think of North Africa, China. There are big producers of natural gas, where natural gas costs a fraction. And these are not countries where electric vehicles are going to be all over the place in the next foreseeable future. So gas mobility will be a key solution, and this already is a key solution in these areas. Let's quickly look at the various solutions. LPG is liquefied petroleum gas. Propane and butane is cheaper than petrol, easy to install. CO2 is 15% less than gas, than petrol, and more importantly, particulate matter, which is what the pollution of existing engines produces, is 90% less. This is the most common solution, has been around for a while. Newer solutions are based on methane, natural gas. Compressed natural gas, minus 20% CO2, minus 99% particulate matter, and no nitrogen oxides. Natural gas can also be liquefied natural gas, and LNG, which is stored at minus 160 degrees, has a very good energy density. It can be transported without pipelines. It is the preferred solution for long-haul transportation, for heavy duty, but also for ships and trains. A variation on this is renewable natural gas, which is also called biomethane. It's produced by biomass. It can be consumed on site, as well as reinjected into the grid or liquefied into LNG. It is the key form of energy for what is now called the circular economy, with no carbon footprint. And last but not least, we have hydrogen, as I said earlier, which has no CO2. As you know, the exhaust of a hydrogen engine is H2O, is water. This is not feasible now, but it will be in 2030, and will be in direct competition with electric engines. The market opportunity, there are about 1.1 billion worldwide car fleet, which is going to 1.3 in a few years. There are about 100 million units of annual sales, going to 180, 2% growth. And Asia is increasingly important in this, as we know. I wrote here gas as a bridge to electrical vehicles. What I really mean is that it is a valid alternative to electric vehicles, and whereas the move is towards decarbonization via electricity, electric alternative fuels will play a very good part and an increasingly important part in the next few years in this decarbonization trend. So at the moment, alternative fuel passenger cars are about 1 to 1.5% of OEM new sales. But the key is that they're going to be much more. The assumption that it will go to 5%, so it's almost tripling the percentage, the current percentage. That depends obviously on infrastructure developments. As we said, the growth markets are India, Russia, Asia, Latin America, Mexico, and importantly, this is all sustained by public incentives and infrastructure. For example, in India, there are 5,000 to 10,000 service stations planned in the next few years. Currently, there are about 2.3 million aftermarket conversions. And Landorenzi Group is a market leader worldwide in this space. They have about 25 to 30% market share. The other major player is Westport Fuel Systems, which has been, like Landorenzi, losing money, and they're still behind in their turnaround. This is a business where you can imagine there are very high entry barriers for new producers. On the production side, there's a heavy component of technology, and for the incumbents, a low cost of evolution. And the key is to have a well-established partnership with OEM manufacturers, which Landorenzi has. Plus, in the distribution, they have 300 dealers and 4,000 workshops in all around the world to do the transformation of cars. In particular, the biggest opportunity is in the medium and heavy duty market segment. In this space, there are about 3 million units annual sales, growing at about 2.5%. But trucks in particular will be and are already more heavily regulated than cars. and diesel will be soon banned. So natural gas is already the best solution for emissions reduction, maintaining the total cost of ownership low. Electric vehicles, on the other hand, are constrained by distribution and their limited range. These are long-haul trucks. They cannot keep recharging their batteries for long. That's the reason why most OEMs already now, Scania, Fiat, Volvo, etc., are offering gas-powered monofuel engines. And Landi Renzo has developed also a dual fuel solution, which allows a truck to switch from diesel to natural gas at the moment. So what are the numbers? At the moment, there are 150,000 units sold, but in 2023, there will be much, much more. My assumption, and I've discussed it obviously with the company, is that it's going to triple. This is a big, big change. So the annual sales of these type of engines will go from 5 to up to 20% of new sales, which means moving from 150 million to a 600 million market value. And whereas for cars, the cost of all the gadgets that we've seen is about 250, that's a big average. For trucks is much more than that, up to 1,100 euros per vehicle. On top of that, the incumbent has, Landi Renzo's incumbent has a good opportunity to aggregate a lot of smaller players that are in this market through M&A. So that's the first business. The second business is gas compression and distribution. At the end of 2017, there was a merger between a subsidiary of Landi Renzo called SAFE with clean energy fuel subsidiary called Clean Energy Compression. Landi Renzo owns 51% of the combined company. It made 24 million capital gain on closing. Clean Energy Fuel is a quoted company, 630 million market cap. It was founded by T. Boone Pickens for a long time ago. Some of you will know. Again, they've lost a lot of money, but they turned around this year. They made a small profit. The combined company is the market leader in Europe, is the second player in the world, and is consolidated on the balance sheet with the equity method. So it's only on the balance sheet at 22 million. Revenues this year have been about 60 million. And again, there is a turnaround expected in 2006 and 2019. I will not have time to talk about the turnaround, but a lot of things have happened in the company. That's why the stock price rebounded, and it will continue to happen. There is more efficiency, more margin improvements, and this is now a profitable company. So I conclude with the investment case. Very simple. This is a company that's been in the space for a long, long time. It's in the star segment. At the moment, it's 135 million market cap with a third free float. Italy is only 18% of their sales. The rest is all over the place, especially Asia, which is the fastest growing region. In 2022, if we're right, revenues will go to 210, EBITDA to 42, and net income up to 20%, to 20 million. So divide 135 by 20. This is my normalized assumption. All of a sudden, the stock is very, very cheap. If you combine that with SAFE Czech, which will have revenues of 110 and EBITDA of 22 million, and remember, it's on the balance sheet at 22 million, this is a value proposition. And hydrogen comes for free because it's a free option. And the key there is that all the gadgets that we've seen are highly adaptable to hydrogen engines. So if hydrogen takes off, Landirense will also take off. That's it.
Okay. Thank you very much, Massimo. Does anybody have any question? If you can tell us, meanwhile, if you like, a little bit about shareholders and the new CEO.
You have a question? Sorry.
Yeah, if you can tell us a little bit about the CEO and the shareholder structure. Any questions meanwhile?
So the company has this weird name, Landirense, which is Renzo Landi. Renzo is Lorenzo Landi, because the founder, the father of Stefano Landi, who was the major shareholder, died prematurely. He had created the company, and Stefano Landi took over and was the president and chairman and CEO for a long time. And he got involved in a sort of messy situation, which I briefly touched upon, and I will in more details if you talk to me later. But the bottom line is that in 2016, 2017, the company was in dire straits and they needed a change. So they hired an external manager, Cristiano Musi, who came from a different industry but had a lot of experience as a restructuring manager, and he basically turned around the company. He reduced his debt. He sold assets, especially in particular, they had a small company, don't ask me why, which produced sound systems. They sold it to another company in which we are invested, which is called BC Speakers. They bought it. They've reduced working capital from 18% of sales to 10%. So there's a lot of efficiency moves that happened. And now the company is on a safe, the debt is about 50 million, so very sustainable. The company is on solid footing to finance their ambitious growth path with cash flows. Free float, as I said, is 33%, so it's plenty of space to get in. And that's it.
Okay, hi. I think CNG is great on paper, but the problem is OEM have been selling CNG cars for the last 20 years, and people are not buying.
I know.
I mean, in the US, it has been extremely valuable proposition, as natural gas is much cheaper than in Europe. But clean energy has been just wasting money for the last 15 years, and people are just not switching and not buying. So you're expecting a tripling of sales in the next 3 years. What is the trigger?
Not in the US. Not in the US, for precisely that reason, and in Europe. But, and you can imagine we've gone through this in detail with the company, this will happen. Will happen in emerging markets, in India, in Brazil. In Brazil, they've just done a deal with Uber to convert all their Uber fleet to natural gas.
But 80% of the taxi are already running on CNG in Brazil.
Sorry, 8%?
I mean, most of the cars are already running on CNG in Brazil.
Well, not the Uber tag. They've just done this with Uber. Uber is going to finance the conversion. So all the Uber taxis are going to be they're not already in natural gas. They will be converted. I'm not sure what the split is between those that are and those that aren't. But just to say that the push towards decarbonization is very, very strong in places like this, and in places where, like Northern Africa, where the price of natural gas is very cheap. So there is, it is an assumption that you have to buy into, okay? If you buy into that assumption, and I can sympathize with the fact that it sounds like, a sell-side pipe dream, okay? So I spent a lot of time to figure out whether it was a pipe dream or not. And the bottom line is that I believe in their plan. And if it's true that they're going to make 20 million in 2023, the company is very cheap, especially if you include the free option of hydrogen. But do your homework. Don't believe my what I say.